I just finished reviewing Tesla's quarterly shareholder letter, which included its latest financial results. And I've got to say, they were really good. Tesla surpassed expectations, even my expectations. And if you've not been following my channel for a while now, I'll let you know that I've been saying that Tesla stock is overvalued and that I've been short Tesla stock. And so even I'm saying that these quarterly results were really good. And I'm surprised Tesla stock price is only up by 6% following these quarterly results. I would have thought the price would be up more than that following these really good results. But I guess coming into the quarter, Tesla's stock price was already so overvalued that even a really good quarter like this hasn't really pushed up the valuation anymore. But I wouldn't be surprised if on the hours and days following, the price continues to move higher because these were really good results. So I'm going to share with you the details of this latest quarterly report, and I'll update my recommendation for Tesla stock. Remember, I said I've had it rated as a, borderline sell and overvalued. I'll let you know if I still think it's overvalued following these results, and I'll let you know what I'm going to do with my short position. Am I still going to keep it, or am I no longer short? So let's get into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so one of the bigger things that came out of this quarter was that the company's cost of goods sold per vehicle came down to its lowest level ever at $35,100. And so the lower cost per vehicle, that gives the company competitive advantages to be able to continue offering incentives and promotions, lowering its price and still generating profit. Very few electric vehicle companies in the world are profitable. Tesla's one of the few of them. Now, the reason why I've been short Tesla is not because it's not a great car company. I think it's one of the best car companies out there, but the fact that it's a car company and that it's trading at an incredibly expensive valuation. Before these results came out, Tesla was trading at a forward price to earnings of around 70 compared to, let's say, Nvidia or Amazon, which are trading at forward price to earnings around 30. So it's trading at double the valuation of tech stocks, not even car companies. It's trading at 10 times the value of car companies. So that's what has driven my bear case on Tesla is the valuation. I've admitted the company's great at its business, but the valuation exceeds that of the business performance. But let's continue here. Preparations remain underway for our offering of new vehicles, including more affordable models, which will begin launching in the first half of 2025. So it's good that they didn't push it out again. Remember, Tesla's been delaying the rollout of the lower priced models for a long time now. It goes to show, they're just in the habit of over-promising and under-delivering. If they tell you something's going to happen in 2025, it usually, according to their own history, probably won't happen until a couple of years later. Or if it does happen in the year that they say it's going to happen, it'll be something that is much worse than they were promising. And in this case, it looks like it is going to be much worse than they were promising. Initially, they were promising that they were going to come out with a model at $25,000. I don't think they're going to get there. I think investors would be happy if they could get it anywhere near $30,000. But I don't think $25,000, and even Tesla has said that it's not going to be as low as they initially promised. And again, that's usually the Tesla strategy, overpromise, and then when it comes time to actually launch the product, you make excuses and you say why you didn't do what you said you were going to do. So one of the more impressive things in the quarter was that they were able to increase automotive revenues by 2%, even though it was just 2%. Still, the fact that they were able to increase EV revenue during a quarter when people were not very interested in buying EVs in the United States, there was barely any growth in the industry overall. And then with the increase in supply, that allowed others to get in and take market share. So for Tesla to still battle in there and generate growth was impressive. And then more impressive was the gross profit margin. I was expecting their gross profit margin to be lower year over year, but they actually generated an increase. 19.8% gross profit margin compared to 17.9% in the same quarter last year. Now, this is despite all of their price cuts and all of the incentives that they've been offering to get these EVs sold because, like I mentioned, people are not that interested in electric vehicles, at least in the United States, right? Less than 1 out of 10 vehicles sold is an electric vehicle, and that's not improving by all that much. And so other regions are much better, especially China is growing much nicer, and that's been helping. But the United States growth is much less than expected. And then the operating profit margin, 10.8% compared to just 7.6% in the same quarter last year. Again, also impressive. And one of the reasons why is their cost cutting. You can see from the previous quarter, 2.973 operating expenses, 2.973 billion down to 2.28 billion. You heard about all of the cost cutting Tesla undertook, and that's helping increase profitability. If you're going to have revenues that are not going to grow by all that much in your most important segment, then you've got to have cost cuts to make sure that profitability increases. And still, you could see 20 billion in automotive revenues, over 25 billion in total company revenue. So still about 80% of the business relies on EV sales. I know a lot of Tesla investors want to think that it's not a car company, but over 80% or roughly 80% of its revenue comes from car sales. And then the other parts of its business, which is services, strongly are correlated with car sales. If it doesn't sell as many EVs, its services revenue is not going to be as strong. So it's still very much an EV business, but the other parts of the business are growing nicely. And I can see maybe 5 years from now, this will be more balanced, but I don't see a future where Tesla's EV revenues are a small part of the business. I still see the EV as being one of the primary sources of revenue for this company. Free cash flow increased hugely to 2.7 billion, up from 848 million in the same quarter last year, more than tripling year over year. Tesla giving the puts and takes here for their revenue and profitability, the pluses and minuses. So for revenue, the growth in vehicle deliveries is front and center. That's the primary growth engine for the business is electric vehicles. The more they sell of these, the more the rest of the business will perform well. And then the minus in revenue is because lower average selling prices due to pricing and attractive financing options. For profitability, one of the biggest benefits was a lower cost per vehicle, although I don't know how sustainable this will be because they say that the reason for that is lower raw material costs, lower freight costs, and duties and other one-time charges. This doesn't lead to an investor to believe that they had lower cost per vehicle because of improvements in the manufacturing process. These are just things like lower raw material costs. This is due to commodity prices, which can fluctuate. Next quarter or next year, commodity prices could increase, and then that will bring down or bring up their cost per vehicle. As an investor, you'd rather see profitability improve because of improvements in manufacturing processes, not improvements in lower raw material costs. Inventory increased a little bit, but not as much as I thought. They have 19 days of inventory on hand, up from 16 days of inventory on hand the same time last year. I would have thought this would have been worse given the macroeconomic factors I highlighted earlier and the disenchantment with electric vehicles by most consumers. For inventory to only increase by this much is okay if you're a Tesla stock investor. Another great milestone for Tesla is that Cybertruck production increased sequentially and achieved positive gross profit margin for the first time. So Cybertruck profitable on the gross margin line. That's great to hear. Hopefully from here on out, things only improve for the Cybertruck, and that can be another profit driver for the company. So far, it had been a headwind for profit margins, but starting in this quarter, it turned positive. And then preparation for semi-factory continues and remains on track with builds scheduled to start by the end of 2025. Again, if you're evaluating Tesla stock, if you're a realist, you can kind of ignore these kinds of schedules and forecasts from Tesla because they've been so bad at providing these forecasts. We don't need to consider these timelines because they've just been so inaccurate. You just wait till the product actually comes out and you start to see revenue and profit, and then you can make assessments. But it's a guessing game as far as when they say it's going to be scheduled by the end of 2025. What do they actually mean? Does this mean by the end of 2026 or by the start of 2027? We don't know precisely when, but we know that it's going to be later than what they say. So why even continue making these kinds of forecasts? I guess there are many Tesla investors that still believe when the company makes a forecast. So in October, they did unveil their Cybercab and Robovan vehicles, both designed from the ground up for autonomy without a steering wheel or pedals. And, I watched that whole presentation and I did a video on it. And again, they gave timelines of 2027 or before 2027 for the Cybercab and the Robotaxi. Again, as an investor, if you want to be prudent, you just kind of push out those deadlines and wait until there's actual tangible evidence of the product and the launch and how much revenue and profitability are actually going to be generated from these products, instead of giving the company credit for doing something on the timeline that they say they're going to do it with the costs and profile that they say they're going to do it. But even if we ignore all of those forecasts and guidance, which I think is reasonable to do given their history, the actual performance of the business was really good. And even the energy business achieved a record gross margin of 30%. And the Shanghai Mega Factory remains on track to begin shipping mega packs in Q1 2025. Again, when they talk about forecasts, you can push it out. I don't know how much out to push it, but I know that given their history, you want to push out when they give you a forecast or a deadline or a guidance for a product launch. So they go on to say that despite ongoing macroeconomic conditions, they expect to achieve growth in deliveries, and energy deployments are expected to more than double year over year in 2024. Great news. And their plans for new vehicles and more affordable models remain on track for production in the first half of 2025. Again, another forecast that we can just push out or ignore, and it doesn't take away from the company's actual performance. I've been, kind of reiterating this every time I see a forecast from Tesla because they've been so inaccurate. But even if you ignore these forecasts, they still delivered a really good quarter. And, there's beginning to start to bring down your expectations with the lower cost model. They've been doing this for a few quarters now, and they're saying they're going to achieve less cost reduction than previously expected. But now they say it'll enable us to prudently grow our vehicle volumes in a more CapEx manner during uncertain times. Okay, so this is what you should come to expect from Tesla. Big promises, and then when it comes time to actually deliver on them, it's either not ready or it's going to be out later with some excuse or another. Or if it does come out, it's not precise, it's not as good as they said or at a higher price than they say. Now, always over-promising and under-delivering. You should reasonably expect that as an investor. Now, I said I was surprised the stock is only up by 6.18% following these really, really good results. But again, it's probably because the price was already up by so much and the business is already so expensive coming in. And to answer my recommendation, do I think it's still a borderline sell, or am I upgrading? Am I changing my opinion on Tesla stock? And the answer is no. I still feel like Tesla is one of the better car companies in the world. They delivered another great quarter. The business is doing very well overall. If you exclude the EV part, they're holding their own, but it's trading at such an expensive valuation that it's above and beyond where I feel it should be trading. I think Tesla should be one of the more expensive car companies, or trading near the valuation of other tech companies like Nvidia and Alphabet and maybe Amazon. Like, it should be approaching those levels, but I don't think it should be more than twice as expensive as those companies. And I don't think it should be more than 10 times as expensive as other car companies. So for those reasons, I'm keeping my borderline sell rating on Tesla stock, and I'm keeping my short position on Tesla stock. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've created a book, I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.